I'm Debashis Basu. Among the many arrogant quips and replies that foreign banks gave immediately following the security scam of 1992 was this: if you keep your front door unlocked, you are likely to be burgled. And this comment came from a cowboy banker from Citibank. He was justifying how foreign banks had hoodwinked Indian public sector banks in the opaque and opaque government securities market to make obscene profits year after year. While the treasury operations were unknown outside the small, shadowy world of the Indian debt market, Citibank was a dominant retail financial services brand as well in the early 90s, setting the pace for retail finance, everything from credit cards to consumer loans. ICICI Bank was still a development financial institution lending money on term loans. Kotak Bank and Axis Bank did not exist, and HDFC Bank was set up only in 1994, which was also headed by an ex-Citi banker. Some 30 years later, in March 2023, the same Citi sold its retail business franchise to Axis Bank and exited the Indian retail banking business. Now, this was not an isolated case. Over the years, the presence of foreign banks in India has been reduced to nothing. The largest foreign bank in India is Standard Chartered Bank, which has just 100 branches in 42 cities. HSBC has just 26 branches. The 38 odd other foreign banks operating in India have an insignificant presence. HDFC Bank alone has more than 8,000 branches. The biggest global banks like JP Morgan Chase, Bank of America, Mitsubishi UFJ, and BNP Paribas are neither not present in India or have nothing much to show on the ground. The top banks in India are State Bank, Axis, ICICI, HDFC, and Kotak. It is a similar story in mutual funds as well. Among the top 10 mutual funds, there are a few foreign joint venture partners, but they have little role. Most funds are entirely Indian owned. The only foreign asset management company among the top 10 is Nippon India. The largest US mutual funds are not in India. Morgan Stanley and Fidelity have walked out from here, and Templeton is struggling to grow. The story is slightly different in insurance, where many foreign insurance companies are joint venture partners because the business is a bit technical. But these two are controlled by Indian management. Life Insurance Corporation of India, a Government of India company, still rules the life cover business. Now, all this is a far cry from the early 90s. If those who remember those days when circumspect Indian policymakers attempted to strike a balance between domestic interests on the one hand, the interests of the depositors and investors and so on, and the strong diplomatic push of US trade representatives on the other. They wanted to smoothen the entry of US foreign financial services into India. Reams of media columns were written on how an aspirational middle class of India, estimated at that time about 200 million people, prospering through economic liberalization, would need retail loans, insurance, and thanks to India's high savings rate, investment products like mutual funds. And who better to sell these to Indians than US companies, which claim to have the best products and investment expertise? Multiple rounds of discussion at the World Trade Organization focused on opening emerging markets to services from the developed nations, which really meant Wall Street. Left-leaning politicians and academics howled about the possibility of neocolonialism brought about by neoliberalism. What happened was exactly the opposite. In 93-94, when 6 private mutual funds were licensed, many of them had foreign partners. Subsequently, more foreign mutual funds entered India, but hardly any of them survived in their original form. The string of early and later entrants who have exited looks like who's who, which is BlackRock, Pioneer, Alliance Capital, Sun FNC, Morgan Stanley, Jardine Fleming, JP Morgan, and Goldman Sachs. In contrast, the survival rate among Indian funds, some with passive foreign partners, is very high. You just look around as JM Financial, DSP, Aditya Birla Group, Shriram, so on and so forth. All of them have grown and grown. Now, millions of so-called proud Indians, which is a very large class these days, would see this trend as a conclusive evidence of the greatness of Indian entrepreneurs and quickly extrapolate this into the future. Everybody talks of this being the India century and so on. While Indian entrepreneurs and managers have indeed shown tremendous talent and execution skills, the quit India policy of foreign financial companies hasn't happened by design, but by default. Quite frankly, all the assumptions made in the mid-90s about the Indian middle class have turned out to be wrong. There was no smooth surge in middle class prosperity for foreign businesses to tap into because the Indian economy continued to be mismanaged. Productivity remained poor, corruption and taxes stayed high, and crony capitalism undermined infrastructure growth in the mid-2000s, resulting in huge bad loans, some 20 lakh crore in the public sector banks. A surge in prosperity between 2005 and 8 was purely due to a massive global boom across all geographies. It drew up the prices of many assets and created a short boom in financial services. But the global financial crisis hit India in 2008, and we were again reduced to the same struggle for the next decade. Foreign firms, badly weakened by the GFC, got fed up, distracted, and began to exit. Indian companies had no such option. They slogged it out. They bid their time and steadily gained in market share. Hence, when disruptive opportunities like digital onboarding of customers happened, domestic banks were better placed to scale up. Similarly, when stock market took off post-COVID, domestic mutual funds and broking firms grew rapidly. Now, while financial sector threw up clear winners, which is Indians, and losers, which is foreigners, note that the same thing has not happened in other sectors. For example, foreign companies in personal products have not quit. Their powerful presence continues. Indian companies have not made much headway in winning market shares from multinational companies like Colgate and Hindustan Lever. Similarly, older manufacturing companies that have stuck out despite all kinds of adverse winds like Siemens and ABB, or car and bike companies like Suzuki and Honda are making hay. The reason foreigners have lost out in the financial services business is because they have been impatient and took a very short-term view. Now, perhaps those traits, which is impatience and short-termism, comes from the nature of the financial services business itself. That's at least what I think. If you like what I said, please do share and do subscribe to this channel if you haven't already. Thanks for watching.